Hot picks. We're looking at retail today. We are joined by Arun Sundaram, equity analyst at CFRA. Arun, thank you so much for joining us. Let's start off with Amazon, if you would. We hear so much about their cloud business, AWS, but you think investors should pay attention also to Prime Days. Why is that important?
Yeah, hey, thanks for having me. Yeah, so I think Amazon's very uniquely positioned because they are not just the industry leader in e-commerce, but they're also the industry leader in cloud computing with AWS. And then they also have that really large advertising business, which is growing really rapidly right now. So if you combine all three of those businesses, Amazon probably has the largest addressable market compared to any other retailer in our coverage, as well as any other tech company in our coverage. So that's why I think the opportunity for Amazon is pretty massive. And of course, with their e-commerce business, they have Amazon Prime and Prime Day. Their upcoming Prime Day is coming up in next week. And those typically are really strong events for Amazon. And usually when you have those kind of strong early savings events, that bodes well for holiday sales as well. So like I said, I think all three of those businesses, e-commerce, advertising, and cloud computing, is all seeing positive momentum right now. And that's why we're pretty bullish on the stock.
The stock has been an underperformer this year. What has held it back relative to the other Mag 7 names, or most of them? What has held it back?
Yeah, I think the biggest thing, so I think for Amazon, the stock really moves on the cloud business specifically in AWS. Like I said, Amazon is the industry leader in cloud computing. AWS is the largest by far. Microsoft Azure is second place. But that cloud business has been growing about 17% over the last few quarters. It hasn't really accelerated. That growth hasn't accelerated compared to like Google and Microsoft. They've seen their cloud businesses, that growth accelerate. So for Amazon, it's been kind of stable over the last few quarters. I think that's held back the stock a bit. But in our view, next year, 2026, we think that growth in AWS could accelerate. Like I said, right now it's around 17%. We think it can be above 20% in 2026. Why? Because one, they're spending a lot in capital investments this year. This year, CapEx is supposed to be up 50% year over year, over $110 billion in CapEx, and most of that is going to AWS. Two, they have a very large backlog business in AWS. And then number three, they have a partnership with Anthropic, a leading AI company. And Anthropic is buying Amazon's chips. It's using Amazon's models as well. And I think that contribution from Anthropic should be larger next year. So we're positive that AWS business could see growth accelerate next year. And that's, I think, going to move the stock higher.
And you like the other great name in retail, but of course, more brick and mortar, Walmart.
Right. Yeah, it's interesting. Yeah, Walmart is one of the largest brick and mortar companies, retailers out there. But one of the reasons we really like the stock is really because of their e-commerce business. E-commerce right now in Walmart US is growing around a 20 to 25% clip year over year. And we think that's going to continue to grow. And actually, most importantly, that e-commerce business for Walmart just turned profitable this year. So if you think about it, over the last several years, even leading up from the early days of the pandemic, that e-commerce business for Walmart was unprofitable, and now it just turned profitable. And I think over time, over the next few years, we can see that profit margins in that e-commerce business be on par with their in-store margins. That bodes well for Walmart's overall margin profile as well. And Walmart, they generate about $700 billion in annual revenues. So if they see operating margins expand, that can translate into some meaningful profit growth.
And can you give us an idea roughly how much of their sales are in America and how much in non-US markets, even a ballpark?
Yeah, I don't have the exact number in front of me, but the majority is in the United States. I think it's around 60 to 70% in the United States. And then they have that international piece, Walmart International. And then they also have Sam's Club, which is their club business. And all three of those businesses are growing well. Walmart US, Walmart International, and Sam's Club. Obviously, we don't talk a lot about Sam's Club for Walmart, but no. I think that's an underappreciated business for them because that club business is growing pretty well.
And then finally, Chewy, the seller of pet products. And we know that pets in some homes take the place of children.
Yeah, this is trend we've seen over the last decade, this humanization of pets, and that's boded well for the overall pet industry. But for Chewy, we think they're an underappreciated name in retail. They're one of the leaders in pet retail, but they don't just sell pet food and pet hard goods. They also sell pharmaceuticals now. They have a pet healthcare business. They sell prescription drugs as well, and they're actually right now just gearing up to open up actual brick and mortar vet clinics as well. So they're growing in new verticals. They're also selling advertisements online, which is doing well. It's a high margin business for them. They're selling insurance as well. They just launched a subscription program, Chewy Plus. They already have a pretty strong auto ship program. I think over 80% of their sales right now come from auto ship sales, which is like a more predictable recurring revenue. And they also just recently, this past few months or so, they launched a fresh food option, and that's another high margin business growing really rapidly as well. And then actually last year, Chewy expanded internationally. They entered Canada last year as well. So if you combine all that, we think they have a long runway for growth there. And on top of that, Chewy has a really solid balance sheet. They have no long-term debt. They're buying back shares. They're free cash flow positive. And for all those reasons, we have a strong buy rating on Chewy.
Arun, thank you very much. Great hearing from you.
Thank you.
Arun Sundaram, equity analyst at CFRA.